Hi everyone, welcome to the collaboration video series between Rationale and Marketsall. The Rationale is a newsletter service providing trade ideas and insightful market analysis, covering all global equities, forex, crypto, futures, and ETFs. And Marketsall is a multi-asset trading platform offering a wide range of currency pairs for trading, including like a major, minor, and exotic currencies. Uh, as well as access to other financial market instruments such as stocks, commodities, and indices. I'm Roy Gulluoglu, the founder of Rationale, and today I'm here to bring you the latest market updates in the financial markets. First of all, to draw a big picture, like where are we now? It's important to understand current environment. The global focus lately centers around whether the Fed has successfully tightened interest rates to fight inflation enough or not, and when they're going to decrease the federal fund rate from the current rate of 5.25 and 5.5 window, that range. And it seems like we're at the end of the monetary policy tightening path. And especially if you follow the recent speeches like coming from Fed's governors, the signal is like the tightening cycle came to the end, and we'll see from the upcoming details of inflation data, non-farm payroll data. Also, I think regional bank situation would be effective on their decision, and also potential bottlenecks might be caused by political tensions if we see any increments in Russia-Ukraine situation, also issues with China and stuff. Those kind of situations will be decisive in the number of rate cuts and the position of the Federal Reserve. So despite the recent data indicating inflationary increases, especially when you check the January and February data, you see that there's a spike in inflation. The overall downtrend is still there. That is a good sign though. However, the absence of negative employment and negative growth, so there is no threat from employment and growth side. This, and in the high interest rate environment, because generally in the high interest rate environment, we would expect to see a harm on growth or like a labor market. And Fed believes that they haven't seen a really threatening issue for now. This high interest rates environment typically help to curb inflation. Despite concerns about the potential recent inflationary spikes, the data supports the employment and growth. So as a result, there is no the urgency to immediate action to lowering interest rates has diminished. But I'll try to dig into these more in depth throughout this video to examine if everything is as good as it is seen. So before switching to this side, as you can see here, this is the December meeting of Fed, the Fed Watch tool. These rates are these are probabilities of hikes. So if you can see here, this 35.5% is the 35.5. Sorry, my pointer wasn't working, I guess. Yeah, 35.5% probability for 3 rate hikes is derived from Fed fund futures. There's a specific calculation for it, and the market also expects 3 rate cuts. So let's continue. So for a better evaluation of general a recent data flow, as you can see in this table, it's better for me, what I generally do, it's better to divide data flow into a real economy related, inflation related indicators, and events, potential event risks, in order to examine this better. So the indicators that you see in this slide are major metrics, and also you can add for sure ISM manufacturing, ISM services, PPIs, Fed beige book, Like there are a lot of things, but I just try to cover some of those data flow throughout this video, and I'll try to go through some of them in depth today. So first, let's start with the non-farm payroll data. I think this is the one of, I mean, probably the most important. That's why it's better to start with that. So the latest data beat the expectations. As you can see here, 275K compared to the anticipated 200K, and the data beat the expectation. And the important part is here, the noticeable aspect lies in the subsequent revisions made to previous month's data. That's so important. Like when you check the like as you can see here, it's revised from 353K to 229K for the previous month. It makes like a notably a revision of 175K was made to January figures. And this is not the only month that we saw a revision, downward revision. The previous, I guess, like a 2 or 3 months, and when you check the like a 3-month average non-farm payroll data has come down, and the downward revision trend, this like keep revisioning downward the previous data, aligns with the contracting economic environment. Thereby, like with taking into consideration this downward revisions, it could be evaluated that economic environment is not that good. So thereby, it might increase the likelihood of Fed rate cuts. So here you can see that the headline number is good. It has been doing well for consecutive months, but when you get in the details, you see a different story. Yeah, unemployment rate. The unemployment figure came like 3.9%, and it's, I guess, highest rate within a year, since the beginning of 2024. And I think it's same with the November 2023 data. But here, what I would like to show is the household employment data. It's the important. As you can see, there is a 184K decrease in household employment. This data is factored into the calculation of the unemployment rate. That's why it's important. It's highly significant data. And this is also significant due to its ability to reflect the status of small and medium-sized businesses. Catching hints from small and medium-sized businesses are like more difficult for us compared to public companies because like they keep like we keep receiving information from them. But therefore, like these kind of like household employment kind of metrics are pretty crucial, and we need to follow. And this downward revision also is another alert that we need to take into consideration. Another metric that I would like to share is public debt to GDP ratio. So this ratio, as you can see, after COVID, then we're coming down. Easing, my bad, and coming down. And the issue of outstanding public debt is crucial and frequently discussed lately, particularly like concerning the decision on increasing debt ceiling. It keeps coming to the table, right? And if this ratio continues to rise, what could happen? So the burden of interest expenses could become unmanageable after a point, and diverting all like government spending toward interest payments, that will be bad for the that will be bad for the especially fiscal side. And like US mainly is not a country that like the government bonds is also sold to other countries. For example, this ratio is here, you can see, is 120. Went above 120%, and this is high. But there are some countries like this. But those countries are not like for example, in Japan, central bank buys those bonds. But in US, for example, Japan has been the biggest US government bond buyer by suppressing China. So the exposure is like from outside, and that's the risky side also. So what factors could potentially decrease this ratio? Mathematically, if we see an increase in GDP, we would expect to see decrease in this ratio. But since like if you take into consideration the previous data that I show, previous data flow that I show, it would be logical to sensible to expect a economic slowdown, and I would expect like an increase in GDP to decrease this ratio maybe after a economic slowdown, which is mainly caused by this like recent tightening phase. And what could be the significant driver of this potential increase in GDP? Of course, like the innovation for sure. It has been the like main narrative of the markets lately, and the potential innovations in robotics, artificial intelligence, and blockchain technology would be really influential on potential like a positive like will be really influential GDP growth, and thus it would be helping to reduce this ratio. Also, temporary help employment gives clue about tendency of businesses, because like this indicator frequently serves as a signal of impending recession. Here you can see the gray shaded area are recession areas. As you can see, when the line is temporary help employment number, when it comes down, the recession follows. When it comes down, the recession follows. When it comes down, recession follows. It came down. We haven't seen recession yet. I mean, at least the recession is not on the surface yet. But yeah, whenever employment amount decreases, recession follows, and that's why it's important data to follow as well. And let's check existing home sales to understand more about like how's the real estate market going on. There is an ongoing long-term decline in the housing market, as it is shown in the chart here. Like people for sure became hesitant to move due to the transition from low rates to high ones. And for sure, this situation is dampening existing home sales, and this is the main driver for this picture. And this, I mean, naturally, we see the negative impact on growth. For example, if you're paying an existing mortgage from a low rate, and I mean, you wouldn't be willing to change your house by converting your like a low mortgage rate to high one, right? So just to wrap up, when we check the real economic indicator side, on the surface, the economy appears to be doing well. Like the recession is not announced. Like also the notable figures supports this, such as non-farm payroll and GDP, especially when you check the headline figures. However, upon closer examination, as we did in like throughout those slides, there are significant points of concern that may prompt the Fed to consider cutting rates sooner than they expected. Yeah, now let's switch to the inflation-related indicators. Average hourly earnings. Yeah, this is the significant, like this data holds significant importance in understanding its impact on inflation, right? Due to the wage pressure. There's a like a economical phenomenon called wage price spiral. It's an economic phenomenon, like let's say characterized by a self-reinforcing loop of raising wages and prices. It typically starts when wages increase, leading to a high production costs for business. In response, these business need more income. Like these business raise prices to maintain their profit margin, but higher prices mean that consumers need more income to afford the same goods and prices, so they demand higher wages. So this is a loop. This increase in wages then feeds back into high production for business and restarting the cycle. This is called wage price spiral. So the latest data indicates a month over month, as you can see, 0.1%, and making the lowest print since February 2022. Additionally, there was a downward revision also here which is a good sign in terms of inflation, from 0.6 to 0.5%. And another angle that I would like to show is concept of unit labor cost. When you divide the average hourly earnings year-over-year data to the labor productivity, which, as you can see here, 2.6%, and the year-over-year average hourly earnings is 4.3. So when you divide this 4.3 by 2.6, you get a number just below 2%, which is the Fed's inflation target. So the chain of relationship is simple though. Like the inflation, the biggest threat on inflation might be wages, right? So in order to understand how wages are doing, we need to understand the concept of unit labor cost. How much cost of a labor per unit? So then we can check this metric in order to understand. And as it is like shown here, like with the 2.6% of labor productivity, this specific analysis suggests that there is no big risk of wage price spiral. So let's come up to the CPI, the recent CPI data. The February CPI came in slightly higher than expected. As you can see, like the expectation was 3.7 and it came 3.8. And on the core side, actually in the core side, month-over-month data is much more important. As you can see, there's a slightly increase, and year-over-year CPI increased slightly as well. So when you check this, like, okay, this is bad, like Fed needs to maintain high rates. But let's dig into details a bit. First of all, core services especially decreased from 5.4 to 5.2% year over year. This, first of all, indicates a progress. But there is like there's work to be done also in the housing costs. The shelter index rose by 0.4%, and this was primarily contributing to the month-over-month increase in the core inflation. This core inflation of 0.4%. So housing costs contributing mostly. And there's a concept called supercore inflation, which is highly important for Fed as well. This is the core service inflation excluding shelter. So since the shelter effect is expected to come a bit like lagged, that's why in order to see the rest of the progress, they're checking supercore inflation. And the recent data suggests that it decreased from 0.87% to 0.47%. The annual change in supercore remains steady at 4.3, but this a supercore inflation gives an indication about wage inflation, and month-over-month data there is a progress, which is a good sign. So the headline numbers seems bad, but for example, supercore inflation, we see a progress. Also in core services, we see a decrease. So to wrap up, it seems like this inflation continues, but the pace has slowed down for sure. And we'll see. We need to follow the upcoming data. And furthermore, I would like to show two other significant metrics provided, one by Atlanta Federal Reserve and Cleveland Federal Reserve. So the Cleveland Federal, this chart is Cleveland Fed's trimmed mean inflation. This metric excludes the largest outliers from either directions and calculates the average of remaining data points. And as you can see in the chart, it has decreased to 3.51 levels from 7%. While the downward trend is evident, there's still progress needed for sure. But this is also a positive indication of an easing inflation. And the other one is Atlanta Fed core sticky price inflation. This consists all products with prices that change slowly and relatively slowly, and are not those are prices that are not easily reduced. As you can see, it has decreased to 4.4% from 6.5%. This is another positive indication on easing inflation. And let's come to the FOMC projections. So in general, like the Fed, first of all, the Fed didn't change interest rates as expected. That was the expected. And this week also, we're at the week, like at the beginning of the April. Today is April 1st, and this week there's a very busy agenda of Fed governor speech. Uh, until now, they have signaled that they don't wanna rush on policy changes, as they don't see any like imminent threat on labor side and growth side. I mean, for sure, this is debatable. As I showed you, like some details might be alerting, but that's how they behave right now. And as a result, they still think they might cut like a rates 3 times in 2024 when you check the dot plot here. So as you can see, the majority falls this range of 3 rate cuts from here. The range between 4.5% and 4.75%. Only there's an important part. Only one governor wants more cuts than 3 cuts. This number actually came down from 5 if you compare with the December meeting. In the December meeting, there were 5 governors who were seeking for more than 3 rate cuts, and now it's 1. This was the a hawkish side of this dot plot. Like within 9 members predicting like a 2 cuts or less, just a single change could raise the median prediction. So I mean, just one member change could push us higher to the 2 rate cuts. Also, during the press conference, that was another important part, because people were expecting some signs of some comments on balance sheet reduction. And in these texts, you can see here, you can find this on the Federal Reserve website. It's highlighted by as you can see here, Chair Powell mentioned they might slow down the pace of reducing their balance sheet soon. And this was the dovish side of the meeting. So one side, when you check that plot, the number of more than 3 cuts, the governor, like the amount of governors, were 5 in the December meeting, and now it's 1. This was the hawkish side. Then the dovish side is Powell mentioned they might slow down the pace of reducing their balance sheet. Here you can see in the highlighted. And this was the dovish side of the meeting. So they didn't decide on anything about like a reduction pace and stuff, but they talked about gradually reducing the pace of selling of their securities. And one other important issue that I want to mention is, which I see as an event risk, is the regional banks and the relationship with yield curve inversion. For a while, I've been keeping an eye on yield curve inversion, because I mean, I would expect it to stop being inverted as the economy gets back on track after the all ups and downs of COVID. Like we see easing phase, like tightening, we're getting back to normal, bottlenecks are down, at least. I mean, the economy is getting better. That's what data suggests, at least. And you would expect to see maybe faster disinversion of the yield curve, but we haven't seen. I saw in the analysis of Cathy Wood, the founder of ARK Investment. She has pointed out that the continued inversion is connected to the risk faced by regional banks. These banks are a big concern because they're heavily exposed, more than big banks, to commercial real estates and multifamily housing. This is really crucial, though. According to Cathy Wood, around 25% of the balance sheet of the regional banks is tied up in these sectors, like multifamily housing and commercial real estate. So if these borrowers can't pay their debts during a potential economic downturn, it could hit regional banks hard. and the fear of these banks defaulting adds pressure to economic growth. And when there is a pressure on economic growth, the high end of the yield curve doesn't go up, because this is and this economic growth pressure cause deflation. The reason behind this is the inflationary or economic growth, like prosperous economies, would create inflationary phases, and you would expect to see, due to inflation, higher rates. That's why you wouldn't be okay with the current long-term interest rate, and that's why you would sell those long-term, and the rates go up. But here, you're like risk off. Okay, there are some risks that I see, like the market. The market says like there are risks, such as like a regional banks issue, and they're buying long-term bonds and suppressing the like putting pressure on the high end of the yield curve, as you can see here. Because in general, like when there's a yield curve inversion, when it comes to below zero, there's a following recession. Look, we have been in the negative territory, like this amount, and we'll see if we're going to see a recession or not. Yeah. So I'll keep a close watch on how the yield curve behaves to understand not only like potential risk to regional banks, but also the likelihood of broader economic downturn. And that's all for today. That's the first video of Rationale and Marketsall collaboration videos. And that concludes today's market update. Please do not forget to subscribe to Marketsall and Rationale for further insights, analysis, and trade ideas across all financial instruments from the link below the video. Until next time, happy investing, and thank you for joining us. Have a good one.